Good morning, traders. Steve Gans here with another episode in the Start to Finish series. So first of all, before I get into that, please make sure that you like and subscribe if you would. That helps me a great deal. And then also, if you have any comments or questions, feel free to put those in the comment section down below as well. So this particular trade started back about 10 days ago. And prior to that, I put out a video about the wheel strategy. It explains how a long-term investor might use options to get into their long-term position, lowering their cost basis in the process. So again, go back and look specifically for the video about the wheel strategy, where I explain the whole concept behind this. So after that video, then we started our wheel. Well, we started our wheel 10 days ago by selling a 115 put. Now, sometimes this is called a cash secured put, and what it means is that when I sell this put, I have to have the amount of money set aside in my account that's required to actually buy 100 shares of Google, because that is my goal with this trade. I have determined that I want to own Google stock, and so now, rather than just running out and placing a limit order to buy Google, back on the day I did this, Google was trading at 118. So rather than just go out and buy it at 118, I sold a put at 115. And when I did that, I took in about $2.14 to sell that. So that's $214 that I took in by selling that put. Now, this put is now only worth 10 cents. So I can buy this put back, and I've made $200. I've locked in $200 of profit, or $2 per share, because again, each put represents 100 shares of stock. So what does that do for me? Well, if I had been assigned Google, so if we look at a chart here of Google, let me come pull up a chart. So if we look at a chart here of Google, if Google, at the time we sold this, we were right here. This is the 21st. So we sold that put on this day. Google did have earnings a couple days later, so that was a little bit risky, but I was willing to take the risk. So let's just say that the earnings went the other way and Google sold off to, 112, 114, something like that. So if Google sold off to 114, I'm going to get Google put to me at 115. But again, I sold that put for $1 or $2 per share, so my actual cost in Google would have been 113. The 115 that I sold the put at, and then because I took in $2 for that, I get it put to me at 115. If it were really only worth 113 at the time, or excuse me, 114 at the time, I'm still up $1 in that trade. Now, if Google had totally tanked, that would have been a little bit of a different story. But again, I was going to be okay with that, or I had to be okay with that in order to put on this trade. I've determined that I want to own Google long term. So I'm just going to keep selling these puts until I get assigned Google. So we're going to go through the next step in our process. Again, we sold our first put at $214 or $2.14. Now I want to close that. So I'm going to buy to close that. I can buy that back for 10, 11 cents. So I'm going to buy to close. That means I locked in $200 in profit. We can see that right up here. So I'm going to go ahead, I'm going to buy to close. So that closed that out, and we've had $203 in gain. Now I want to go sell another put at a specific price point. So when I come over here and I look at Google, I tend to use my points for selling puts. I tend to use just a little bit of basic technical analysis on this for the most part. So if I look at this and I envision a possible pullback in Google, I'm thinking, unless there's something dramatic in the market or in Google, I'm thinking that pullback's probably going to be here in the, maybe 126 range, 125 range, somewhere in there. A case could be made many times when a stock gaps that it will come back and fill the gap. So maybe if it filled the gap, it would come all the way down here to 123, 124. Personally, I don't necessarily see that, particularly when we look at the volume. I do use volume as an indicator here. Look, anytime we have up moves, there's massive volume on those up moves. Buyers are flooding in when Google has these up moves. So that is a little bit of an additional indicator to me that tells me that if Google dips back here, we're likely to get another wave of buying coming in, and then these people are going to flood back in. So that's why I'm fairly secure with Google pulling back here maybe to the 126 range, somewhere in there is kind of where I might envision a turning point. So based on that, let's come back and see where I might sell my next put. Now, the first thing I'm going to do is I'm going to go out in time to the next monthlies. This is a personal choice of mine. I just don't want to be hyperactive in the stuff that I am trading. So a case could be made that you sell these weekly. Every week you sell a put, and you will probably end up collecting much more money doing that, because between now and September 15th, well, that's going to be 6 weeks. Well, I could sell 6 weeks worth at, let me just pick a price here. Let me pick a 127. So if I were to sell a put here, and again, I'd probably sell it around this 127 range or so. So, I'm only going to get 57 cents, but if I get 57 cents 6 times, that's going to be about $3 or $300 if I did this every week. Now, again, my plan is not to do it every week. I'm going to do it, go out to the next monthlies here. So if I go out to the next monthlies for this and I look at this, well, I'm going to get $2.40. So it's a little bit less money than if I were to sell it every week. But again, I don't have to be that active in this at this point. So I want to go ahead now and I'm going to sell this and basically add to my wheel strategy. Again, I've closed out one part of the wheel, so now I'm going to go ahead and I'm going to sell a new put at a new price of $127.50 for about $2.50. And if Google stays above this price and or continues higher, I will end up locking in this additional $2.50. And then I will have put about $4.50 into per share into the quote-unquote bank for my Google purchase. So then if I were to get assigned at $127.50, if you take $4.50 off of that, my actual buying price then would be around $123. So, and we just keep doing this month after month after month, lowering our cost basis. Then once we do finally get assigned Google, the next step of this game is going to be to go ahead and actually start selling calls against our position. So now that we've sold our $127.50 at $2.46, we're just going to set tight here and wait for getting closer to expiration. Or if Google were to rocket up here at this point, maybe we would close this one out early as well for a few cents and just sort of continue to chase Google up. Again, every single time we do this, taking in a couple of bucks and lowering our cost basis along the way. So, right now, as we can see, our break even on this is down here at 124. And that's for this particular put. That's not taking into account this prior one as well. So if we've taken in a total of $4 in this case, which we have, and let's see, actually that does take into account that prior one. I apologize. So if Google were to pull back here to the 127.50, which is right around in here, we would and we were forced to buy it there, we would still be up nicely. We would still be up over $2 a share in that position. So again, each time we do this, we just kind of build more and more buffer, or more, we lower our cost basis each and every time we do this. So again, this is the start of our wheel. We're still awaiting assignment, and maybe we'll get assigned on this month. Maybe Google will, stay above 127.50, and then next month around this time, or excuse me, actually it wouldn't be around. Well, it might be around this time if Google continues up. But at some point in the next 4 to 6 weeks, if Google has not pulled back to where we're going to get a sign, we will just roll this thing again, taking in another couple bucks, and then we'll be up around $6 or $600 that we've taken in, so that when we do finally get a sign Google, our cost basis is lower. So again, that's the objective here, is just to continue to follow this along, sell puts until we get a sign, and then once we get a sign, we're going to start selling calls that will lower our cost basis yet further. So that's it for now. Again, please like and subscribe if you would. I greatly appreciate it, and you'll hear back from me on this. Probably won't be for a few weeks, but when that happens again, to where the cost basis, or excuse me, the cost of this put that we sold, when this thing drops down to a few pennies, we'll come buy it back and lock in that profit again, or we may get assigned in the meantime. But again, I'm fine with either one. That's part of my premise here. So thanks so much, everyone. Take care.